Hey everybody, welcome to the podcast. And before we get into my special guest here today, I just want to talk real quick about these different platforms. I know a lot of you listening on Apple Podcasts, some of you on Spotify and iHeartRadio. Be sure to subscribe, but also leave us a review. Anything that you want us to talk about. We have a lot of different guests on the financial markets, and or just comments on how the show went. So today, as I mentioned, I do have a special guest with me. And, as you know, I bring a lot of different guests on with many different skill sets. Today, I have Mr. Tom Joyce on the podcast. Tom, how you doing today?
Good. How you doing?
Good. I'm doing real good. I know you specialize in a lot of different things, and you specialize in retirement and retirement planning, but just retirement strategies for individuals to utilize in these financial markets. Now, before we get into that, I want you to just dissect this market. I was actually doing a podcast last week, and we were talking a lot about the volatility and how volatile it was months ago. It slowed down, came back again, and this week it's been a different type of week. We've had some volatility, but we also had some sideways action. What's happening in these financial markets, and how can people really capitalize on these movements that we're seeing?
Well, I don't know as far as, people ask me all the time because I've been around for quite a long time. They'll ask me what's the market going to do? What do I expect? And, the one thing I typically tell them, I don't have a crystal ball. So in the bigger picture, I always tell them from a trading background that I don't know, I don't care, I just prepare.
Exactly.
And, there's a lot of great analysts out there, and some of the best, I would say, they call them hindsight analysts. They're never wrong. Mm-hmm. It's just unfortunately they can't tell you ahead of time what's going on. And to your point, when you talk about volatility, the one thing I've seen within the last few months is, volatility is crazy. VIX has set new records. Mm-hmm. It did remind me of '87, believe it or not. A little bit of
the fast crash.
Oh yeah, well, actually,
or the flash crash, as said.
Actually, in 1987, I'm talking more. That was that last recession. The flash crash was May 6, 2010.
Okay.
And same thing there. That was crazy. Now, some people would say, "Oh, that was an awful time." Well, it depends who you ask.
Exactly.
So all derivative products out there, they're a zero-sum game. So you always hear about the people whining and crying. What you don't hear about are all the people who are winning.
Yeah.
And they love to literally stay under the radar, obviously.
Yeah. No, you mentioned it doesn't matter what's happening in these markets. That's kind of what you're alluding to. But what do you mean by that? Because everybody profits. Everybody knows that there's profits in up markets. What about these down markets?
Well, in a funny way, in particular to what, I was just piggybacking off what you said there, the volatility. The one thing in the 25 years plus that I've been following this, actually 30 years or more, is this last move was treacherous. And the one thing that caught me in particular, unlike '87, was the velocity of the down move. The velocity. Okay. And so now you've also seen within the last 6 weeks the velocity to the upside.
Yeah.
So anybody out there who's a volatility or trader wants to take advantage of volatility, not only do you have that, you have the velocity of it as well. And to me, that does not spell necessarily risk, it spells opportunity.
Yeah, that's what it's all about is opportunity. There's so many opportunities in these financial markets, but people don't know how to capitalize on them. Now, let's get on the retirement side of things. I know you have a lot of expertise in retirements and retirement strategies, and you teach a lot of those, different strategies. Now, we have a lot of listeners that have retirements, but they don't really feel like they're traders or investors. They actually are, but they're putting all their money into the hands of typically somebody that they don't know. Now, let's just kind of unpack a little bit self-directing your own retirement, because everybody puts money with somebody, their friend of a friend of another friend, and they just hope it goes up. Mm-hmm. Now, there's strategies that you can do when you self-direct. Kind of talk about those different strategies that people have the opportunity to utilize.
Okay. So in particular, what I would start out with, and I just want to, kind of put you in a state of mind, all, the listeners out there, and, whether you're up in Bemidji or you're down in the Hudson River area there, or you're from Duluth to Detroit Lakes. As you're going along, play along with me here. Even if you're driving, I just want you to raise your hand. Just don't get an accident. I'm going to ask you questions, and you'd raise your hand like, yes, that's me. So I'd ask you this. Anybody out there, if you have a home or a condo, I'd ask you if you had insurance on it. So raise your hand. Okay. By the way, Josh didn't share this with you, but we're trying this new thing out. Anybody listening to us, we can see you now. Okay. So that's a lot of hands raised. Good for you. Okay. Anybody out there who's in a vehicle or driving a vehicle or has a boat, motorcycle, car, truck, whatever it may be, do you have insurance on that? Raise your hand. All right. Very good. There's someone up there in Nisswa that did not raise their hand. Raise your hand. All right. Now let's keep going here. What about health insurance or life insurance? Anybody have insurance on that? Raise your hand. So sure enough, everybody's raising their hand. Very good. Makes sense, doesn't it? Now let's go to your nest egg accounts. Your IRAs, your 401ks. Raise your hand if you have insurance on that.
I wish I had a crickets sound on here because nobody did anything there.
Yeah, it's a lot of quiet people out there. Everybody has two hands on the wheel right now. So what it tells me is you are gladly paying insurance and protecting against the downside on where you live, what you drive, how you feel. Yet the one investment that you're going to live off the rest of your life, you have no protection on. None. And we think about it, whether it's the last 10, 15, 20% of our life, that's our nest egg. We cannot afford to lose it. So in these classes, what we talk about in particular are, if I am paying in decade after decade, the first rule in my mind is rule number one is, if we were talking about the Hippocratic Oath, do no harm. Do no harm. So if you have a nest egg there, you cannot afford to lose it. Now, having said that, well, I guess you're right. Maybe there is something I should do. I should be protecting my nest egg. And most people out there, I can tell you this, your nest egg, you're all long everything. Everyone out there listening to me, I know you're long. Why? You have to be by law. So your IRAs, your 401ks are considered qualified accounts or cash accounts where you have to be long. Okay? So some people would ask, well, if I have to be long, there's no way I can take advantage of a downturn. Well, first and foremost, there are times when, as far as the timing of the market, if it's starting to look ugly, you may just have to get out. And when I say that, go to cash. And to remember this, to take an action is no action. And so just really, just in the bigger picture, to take no action is an action is what I meant to say. So just, just realize first and foremost, do no harm. Now let's go a step beyond that. Let's say you do have a nest egg there and you do want to buy insurance on it, like you do on your house, your car, your health insurance. And there are ways to go about that. And yes, that can do with derivative products, whether it happens to be options or futures in particular. And then the first thing people tell me is, well, if I want to buy some downside portfolio insurance on my nest egg, say in the form of buying protective puts, and those are options out there. Most people would say, well, that's going to cost me money. Well, it does on your house, your car, your auto.
And everybody still does it.
Yep, you're right. And so think about this. It's funny what Josh just said there, shaking his head, is everybody out there, you don't think twice about re-upping your insurance as it's about to roll over or expire. You always re-up. And the same people who, to me, sometimes who complain about how much it's going to cost to insure their downside are the same people who buy Apple Care products on their Apple products. Mm-hmm. And, so funny enough, there's a price to be paid for it. The next thing people will ask me, well, where should I have my insurance policy kick in? Depending on where the market's trading, should it be down 3, 5, 7, 10, 12, 15%? The answer is yes indeed. And so you have to determine that. So most people would say, well, I guess I'd have to do a little cost analysis. And I always tell them, at what point are you uncomfortable?
Yeah.
And that's probably your answer. And then the next thing they will ask me is, well, how long should I have my policy for? Well, the same thing. You can customize your policy for your situation. You may want to go out 3 months, 6 months, 9 months, 3 years. You may want to go out past the next election. Mm-hmm. You may want to go out past the the beginning of the pandemic if it starts up again.
Yeah.
So it's just, it's a matter, I can tell you this, though, no matter what you do, the further out you go, the more you're going to pay in premium because you're buying more time.
Correct, yeah. Why do you think, you mentioned nobody has insurance on their portfolios. Everybody has it on their cars, their homes, themselves. Why don't people do that? Or is it psychology, or maybe it's just they don't know?
I would say, for all the people who didn't raise their hand on that last question, which was 98.23% of people out there, it's because they don't know. And so don't be upset that you didn't know, because you've heard all along, hey, buy and hold. Over time, things should be better.
Yeah.
Now, remember, anybody out there telling you to buy and hold, for you to buy something, somebody needs to sell it. Well, who's selling it? Sometimes the very people that you bought it from.
Sure.
And so, I will say this, just to put things in perspective, don't be upset with yourself if you're not even thinking I should have some downside portfolio insurance. Think about this, though. Let's say at the end of a quarter, if you have health insurance for a quarter, you got to ask yourself, do you get to the end of that quarter, go home, you've been feeling pretty good, you're eating right, you're watching your weight. Do you sit there in a room at night after that last quarter of making payments on your health insurance and say, dang it, I wish I could have gone to the hospital and had those smells and saw the snap of a rubber blue glove, right? No, nobody does. And so we do it because it's part of, who we are and what we do.
Yeah.
We are, in essence, we are, protecting against catastrophic.
Sure.
So the same thing, that same mindset has to go over to our nest egg.
Yeah. And just we're looking at a chart here I know for our podcast listeners, they can't see this, but just to illustrate this, from 2000 till now, 2020, the market is up, it looks like about 115%, which a lot of people think, well, that's phenomenal. But break that into 20 years. That's roughly about 5.75%. And if you're listening now and you say, okay, I have X amount of dollars, add 6% on that. What is that going to really get you? And that's why we have a retirement crisis, is people are in these buy and hold strategies and they don't have plans for downturns, because you have to retire at the exact right time in the market, get in at the exact right time, which would be the exact low and the exact high for that to work. And I don't know anybody that's done that.
No, and the other thing is, you say when you put out those numbers annualized there, people out there listening got to remember inflation's low, historically low right now. If inflation ever kicks in, you're not doing very well.
But that's still at 2.5%?
Yeah, well, it's actually, let's say it is there, but even right now, according to who you listen to, it's less than that.
Yeah, there you go.
Less than that.
Yeah.
And so, having said that too, most people say, well, I'm going to get defensive and I'm going to go into fixed income products like bonds. Well, anybody out there know your bond yields right now are next to nothing.
Yeah.
And so,
same as CDs, there's nothing there.
Yep, there's nothing there at all.
Yep.
And so, really, in my mind, so what we hear here, right, is you're realizing, gosh, I have downside protection on everything else in life, yet I don't have it on my nest egg. So having said that, let's think about this now. Typically, whenever you're talking about insurance, whether it's your house, your car, your health, your life, or your nest egg, this just in general, you always look for insurance when you want it, not when you need it.
Yep.
And most people, unfortunately, they make the mistake of running after that insurance when they need it. So when the house is on fire, it's tough to get a policy.
Yeah.
Right? Anybody out there with pre-existing conditions, sometimes it's tough to get certain types of insurance.
Yep.
So the same thing in this last free fall that happened in February, March there, February in particular, the last free fall, people who had heard this message before, they're like, I got to go get some insurance. Well, if you had tried to go get some insurance after the fact there, put things in perspective, on some of the numbers I was looking at, you were probably paying, well, when I first looked at it, 8 times what you would have paid for months before.
Yeah, that's why it's so important, especially in the financial markets, to be proactive rather than reactive. And that's what it's all about in anything in life. I mean, you want to have insurance before something happens. But that's just, think about that. People insure everything in their lives. They don't insure what they worked all their life for. and that's sad. But it's just a lot of people just don't know that's available, and that there's opportunities there. You mentioned the crash or the drop, we'll call it, in February. Well, there was opportunities there. And so it's just being able to understand that there are opportunities and then capitalizing on that. So that's some good food for thought.
It's funny what you said there too as well. Everybody out there, as Josh said, the terms, you're taught that buy and hold's good and you just give it time. And if you looked at the S&P over whether it was 10 years or 20 years, are we higher from there? Absolutely. Right? But you take into consideration those annualized returns. And the other thing to take into consideration, especially if you're out there and you were middle-aged or older, is in general, I've always said this, in general, the buy and hold strategy works like a charm if you're a vampire, right? If you live forever or you go to sleep and then come up 800 years later, it's probably a great strategy.
Yeah.
But those of us with a shelf life realize the market could have been good to people you've known in the past because they ran up. They happened to retire with a nice nest egg. Maybe they went into fixed income before any, equities, drop, and it's fine. But anybody out there who is trying to retire within the last 6 months or even right into 2008 or 2000, they find themselves still working.
Yeah, that's the down thing. And history always repeats itself. So, we're not trying to scare people. The markets are a phenomenal thing. There's a phenomenal opportunity in there, but you have to be educated and you have to have the knowledge, but also the skills. And that's the beauty of that is learning the skills, just like any other profession. Doctors, pilots, construction, carpenters. We were talking about carpenters earlier. Yeah. You have to learn the skill. And it's not rocket science. People just haven't been taught yet. So I appreciate you coming on the podcast here today and just dropping some knowledge on retirement strategies that they're out there because the average person just doesn't even know it's available. So I appreciate you coming on the podcast today. And hopefully when you're back in town, I'll be able to have you on again.
Sounds good, Josh. Thanks for having me.
Yeah, thanks, Tom.